Listen carefully. If you think silver is just a chart game, if you're watching RSI oscillators and drawing trend lines and marking resistance at $80 and thinking that's how you understand this market, you're watching the trailer, not the film. You're seeing the surface while missing the structure. You're focused on price action while the real story unfolds elsewhere. Because the real market, the actual mechanism determining where silver goes and how it gets there, isn't happening on your screen. It's not visible in candlestick patterns. It's not apparent in technical indicators. The real market is happening in delivery timelines, in how long it takes to actually acquire physical metal when you place an order. In premiums, the spread between what the screen says and what you actually pay, and in who is quietly, persistently demanding physical metal when it's inconvenient, when it would be easier to wait, when patience would make more sense from a trading perspective. And I'm going to tell you something I truly believe based on watching these markets for years. Based on monitoring structure rather than guessing about direction, we're entering a phase that feels worse than COVID did for physical silver availability, not emotionally, not in terms of panic or fear or social sentiment. Mechanically, structurally, the plumbing is tightening. The mechanisms that allow smooth functioning are constricting. And the March delivery window on COMEX, March is where this goes from tight to tested, from strained to breaking point, from manageable stress to potential credibility crisis. Before we go any further, welcome to the Exposure Index. Quick disclaimer that's not pro forma, but genuinely important. This is not financial advice. This is not a recommendation to buy or sell any security or commodity. This is market structure education. This is analysis of how physical commodity markets function when supply tightens. This is examination of delivery mechanics and what they reveal about underlying conditions. Do your own research. Consult qualified professionals. Speak with advisors who understand your specific situation. Don't make investment decisions based solely on any single source of information. Now let's break down what's really happening. Let's examine the structure systematically. Macro framework first, then micro mechanics. Here's the framework for understanding current conditions. When liquidity surges, when central banks expand balance sheets, when governments run massive deficits, when monetary expansion accelerates, that liquidity doesn't stay politely inside stock charts. It doesn't remain confined to equity markets. It doesn't respect asset class boundaries. It spills into real assets, into commodities, into metals, into anything that can't be created with a keystroke, into anything with finite supply, into anything that requires actual production rather than just ledger entries. And right now, the biggest macro driver affecting commodity markets generally and precious metals specifically is simple and undeniable. Major economies are debasing aggressively. The United States expanding money supply, Europe dealing with fiscal pressures, Japan managing debt loads, China balancing growth and stability. Debasement isn't conspiracy, it's policy. It's the visible, documented, openly discussed response to debt levels that cannot be serviced without monetary expansion. And when debasement happens at this scale, when multiple major economies simultaneously expand money supplies, commodities don't respond gradually. They don't rise smoothly. They don't move in predictable increments. They respond like a dam that's developing cracks. Pressure builds, stress accumulates, small fissures appear, then suddenly the structure fails and water rushes through. Now add another critical layer to this macro picture. The West still runs a huge portion of silver price discovery through paper structures, through futures markets, through swaps and derivatives, through unallocated accounts and synthetic exposure. Paper mechanisms that allow leverage, that create claims exceeding physical backing, that operate on assumptions about settlement rather than delivery, while the East, China, and India and Middle Eastern buyers increasingly demands metal, physical metal, allocated bars, actual possession, real ownership rather than claims. That's not ideology. That's not cultural preference. That's how the flows behave observably. Watch where metal moves. Track shipping data. Monitor vault transfers. The pattern is clear and persistent. And when paper price discovery meets physical demand stress, when Western derivative markets confront Eastern physical accumulation, something always happens predictably. Paper tries to delay reality. Futures markets try to manage price. Derivatives attempt to satisfy demand without moving metal. Unallocated accounts hope claim holders don't demand allocation. The paper structure resists acknowledging physical scarcity. And physical eventually forces the price to catch up. Eventually, reality overwhelms paper promises. Eventually, the weight of actual supply-demand forces price to reflect scarcity rather than derivative positioning. Here's what most market participants get wrong fundamentally. They think price tells the full story. They think if you know the closing price, if you see the chart, if you track the technical levels, you understand the market. But in physical commodity markets, in markets for actual goods, not just financial claims, price is only half the story. Price tells you where contracts settled. Price tells you what speculators paid for exposure. Price tells you what the marginal paper trade executed at. The other half of the story is availability. And availability shows up not in price charts, but in delivery times extending, in how long you wait after paying to actually receive metal, in premiums rising, in the spread between spot price and what dealers charge increasing, and in the two-price world emerging. Screen price, what futures show, versus acquisition price, what it actually costs to obtain deliverable metal. When deliveries start taking weeks and weeks, when what used to arrive in days now takes a month or more, when lead times extend continuously, that's not normal demand. That's not healthy market functioning. That's a system that's losing slack. That's capacity being consumed. That's buffers disappearing. And slack is everything in a tight commodity market. Slack, spare capacity, excess inventory, that's what allows markets to absorb demand surges without price explosions. That's what prevents small changes from creating large impacts. When slack disappears, when buffers drain, when there's no excess capacity to absorb variation, markets become fragile, become explosive, become prone to gaps and spikes. Now let's get specific about structure, about how COMEX actually operates and why certain windows matter more than others. COMEX, the New York Commodity Exchange where silver futures trade, operates on a delivery cycle. Certain months carry heavier delivery pressure, months when contracts mature and settlements happen. Specifically March, then May, July, September, December. These are the active months. The months when delivery activity concentrates. The months when the system faces its heaviest stress. The market expects those months to carry the load, expects delivery appetite to concentrate in those windows. Expects the other months to be quieter, to be about rolling positions and adjusting exposure and positioning for the next active month. January is normally one of those quieter months, rolling month, positioning month, less urgency, less delivery stress, less pressure on physical inventories. But what I'm watching right now, what the data is showing clearly, what should concern anyone monitoring market structure is this. January isn't acting like January. January is showing delivery appetite that looks more like March. January is experiencing stress that normally appears in active months, not quiet ones. And when a quiet month starts behaving like a delivery month, when positioning that should happen gradually happens urgently, when contracts that should roll forward instead stand for delivery, it's a warning. It's a signal that the buffer is being consumed early, that participants aren't waiting, that urgency exists where patience should. That is exactly why I keep saying March is the main event, why March matters so critically. Why the March delivery window could be a defining moment for silver market structure. Because if the system loses its breathing room before March even arrives, if January already strains capacity, if February shows continued stress, then March becomes a stress test, not just a settlement month. March becomes a credibility moment, a test of whether the physical backing actually exists, of whether claims can convert to metal, of whether the paper structure can deliver when tested. This is where conviction comes from, not just from numbers alone, not just from seeing delivery notices or inventory levels, from the pattern, from recognizing behavior that signals changed conditions. When you see physical demand hitting in an inconvenient window, when industrial buyers are standing for delivery in January rather than waiting for March, when urgency appears where patience would make more sense, you have to ask why now? Why not wait? Why demand metal immediately rather than rolling forward? Why take delivery in a traditionally quiet month? Because if you're an industrial user, if you're managing supply chains for solar panel manufacturing or electronics production or defense systems or EV battery assembly, waiting is a risk. Delay is dangerous. Assuming availability continues is gambling with production schedules. And when industrial buyers feel supply chain risk, when procurement officers see signals of tightness, they don't behave like traders. They don't optimize for chart patterns. They don't wait for technical confirmation. They behave like people with production lines behind them, with contracts to fulfill, with delivery commitments, with revenue at stake. They buy because they must, not because the RSI is oversold, not because price pulled back to support, because they need metal and waiting risks not getting it. Here's the best analogy I can give you for understanding what's happening structurally. This looks like a bank run, but instead of depositors lining up outside a physical bank demanding cash from their accounts, contract holders are lining up at the delivery window demanding metal against their futures positions. The mechanics are identical. In a normal functioning system in a healthy bank, most depositors leave money in accounts. They don't simultaneously demand cash. The bank operates fractional reserve, keeps partial backing, relies on most claims staying as claims. In a normal functioning commodity market, most futures contracts settle financially. They roll forward or close out or cash settle. The exchange relies on only a minority standing for delivery. But when confidence cracks, when depositors fear the bank might not have their money, when contract holders worry the exchange might not have their metal, behavior changes. Everyone tries to convert claims to physical simultaneously. Everyone demands what they're entitled to. Everyone wants certainty rather than promises. And once that psychology spreads, once the bank run or delivery run mentality takes hold, it becomes toilet roll syndrome. The panic buying phenomenon we saw during COVID, nobody wants to be last. Because if you're last in a bank run, you get nothing. Your claim becomes worthless. If you're last in a delivery run, you don't pay a slightly higher price, you pay any price, or you don't get it at all. That shift, that transition from price sensitivity to availability sensitivity, from caring about cost to caring about access, that's where squeezes are born. That's how markets move from tight to explosive. That's the phase transition that creates discontinuous repricing. Let me say this plainly so there's no misunderstanding about market structure fundamentals. Futures markets were never built for everyone to take delivery. That's not their design. That's not their purpose. That's not what they were created to do. They were built to hedge, to allow producers and consumers to lock in prices, to price risk, to transfer exposure, to provide leveraged speculation without moving physical commodity. They assume their entire structure depends on assuming that most contracts settle financially, that positions roll to the next month, that speculators close out before delivery, that only a minority of participants, the actual industrial users with genuine need, stand for metal. The entire system, the inventory backing, the warehouse network, the delivery mechanism is sized for that minority percentage. So what happens if more participants decide they want physical? If the percentage demanding delivery rises from normal levels to elevated levels, if contracts that usually roll forward instead demand settlement, if speculation shifts from paper exposure to physical accumulation, the system faces two ugly paths, two options, both painful, both revealing structural weakness. Path 1, go into the open market and source large amounts of metal quickly. Buy from producers, buy from dealers, buy from holders. Acquire the metal needed to satisfy delivery demands that exceed available inventory, but that forces price to gap. That creates explosive moves. Because you can't quietly buy massive amounts of a tight commodity. You can't source millions of ounces without moving markets. The very act of trying to maintain system credibility by delivering metal forces the price higher, creates the spike, validates the shortage narrative. Path 2, change the rules, cash, settle contracts that should deliver metal. Restrict behavior, limit delivery requests, alter terms, delay delivery, extend timelines, create friction, or otherwise protect the system from a physical drain that would expose insufficient backing. We've seen versions of this in other commodities before. We've seen exchanges alter settlement terms during stress. We've seen force majeure declarations. We've seen rules change to protect the system rather than honor contracts. And once the market learns that paper can't reliably convert to physical, once participants realize contracts might not deliver, once trust breaks in the conversion mechanism, broken trust is explosive. Capital flees paper, premiums explode, physical becomes unobtainium. Two price markets persist indefinitely. This is the core point about current market structure. Silver doesn't have one price anymore. It's not a unified market with single price discovery. It has at least three prices operating simultaneously. First, the benchmark screen price. What COMEX futures show? What spot quotes display? What financial media reports? The paper reference price. Second, the real acquisition price, what it actually costs to obtain physical metal when you buy from dealers. Screen price plus premiums plus delivery reality. The price participants actually pay. Third, the Shanghai linked physical reference, Asian market prices, often meaningfully higher than Western paper prices. Physical trading in markets where delivery is assumed not optional. If the market were truly well supplied, if abundance existed, if physical was readily available everywhere, these prices would converge quickly. Arbitrage would close gaps. Traders would buy cheap in one market and sell expensive in another until prices equalized. But when the gap persists, when Shanghai trades consistently above COMEX, when physical premiums stay elevated for weeks or months, when two-price behavior becomes structural rather than temporary, it tells you something uncomfortable. The metal is not freely available in the form, size, and location needed. The arbitrage that should close gaps cannot function because moving metal faces constraints, because sourcing deliverable supply is difficult, because the paper price is disconnected from physical reality. You don't need the world to run out of silver completely for a squeeze to occur. You don't need zero inventory globally. You don't need production to halt. You only need silver to be in the wrong place, wrong form, at the wrong time, while demand is urgent. That's enough. That's sufficient to create explosive repricing. If silver sits in vaults in London but industrial buyers need it in Asia immediately, if metal exists as large bars but demand is for smaller sizes, if inventory is allocated to long-term holders rather than available for sale, the market can be simultaneously oversupplied and short, can show large total inventories while experiencing acute shortages. Another piece that most analysis underestimates or ignores completely. China isn't just a buyer of silver. China isn't just accumulating metal for reserves or industrial use. China is a refining and processing node, a critical part of the global supply chain. Much of the world's silver gets refined in China, gets processed into deliverable forms, gets fabricated into products. When refined silver flows become restricted, when export licensing tightens, when policy creates friction in outbound metal movement, the ripple doesn't show up first on the spot chart. It doesn't immediately impact futures prices. It shows up in premiums, physical premiums in markets outside China, delivery delays for Western buyers, acquisition costs rising even while paper prices stay stable. Premiums are the market admitting replacement is hard. Premiums are the market acknowledging that sourcing metal at spot price is impossible. Premiums are the mechanism through which physical reality forces itself onto paper markets that would prefer to ignore scarcity. And when replacement is hard, when sourcing is difficult, when delivery is uncertain, a paper price becomes a suggestion, a reference, a benchmark that doesn't reflect transaction reality, not a price where actual metal changes hands. Now zoom out from immediate market mechanics and look at what the world is building, what the global economy is constructing, what industries are expanding, AI infrastructure, massive data centers consuming enormous power, power systems being upgraded, grid infrastructure being modernized, 5G networks being deployed globally, electronics production at scale, solar panel manufacturing accelerating worldwide. Silver sits inside the electrical nervous system of that entire build-out. Silver conducts electricity better than any other element. Silver reflects light perfectly for solar applications. Silver doesn't corrode. Silver performs reliably. Silver is irreplaceable in many high-specification applications. Is every unit using the same amount of silver forever? No. Engineers optimize constantly. Manufacturers reduce material costs. Technology evolves. Thrifting happens. Silver loading per panel declines. Silver content per device shrinks. Efficiency improves. But there's a floor where physics stops you, where performance requirements demand certain silver content, where reliability specifications require minimum quantities, where you cannot engineer silver out further without compromising product. At scale, across billions of devices and millions of solar panels and thousands of data centers, the demand is structurally strong, and in many segments, it's inelastic. Companies won't shut a billion-dollar production line to save a small percentage on materials cost, won't miss delivery deadlines because silver rose 20%, won't sacrifice market share because metal got expensive. They'll pay up. They'll absorb cost increases. They'll pass expenses to customers. They'll do whatever necessary to maintain production. And that's how industrial demand becomes a bid that doesn't leave, becomes support that doesn't disappear when price rises, becomes structural buying that persists regardless of chart levels. Here's one of my strongest beliefs about how to approach this market in current conditions. Trading physical silver like it's a day trading instrument, like it's a stock you can flip for quick profits, like it's a momentum play with tight stops, is a mistake in a market like this, a potentially costly mistake. Because premiums, spreads, and delivery delays can destroy you even if your directional call is correct. Even if silver does go higher, even if your prediction about price proves right, if you're trading physical rather than paper, if you're buying and selling actual metal rather than futures or ETFs, the transaction costs and timing frictions can eliminate profits. I'm not saying you can't trade paper instruments. Futures work for speculation. Options provide leverage. ETFs offer liquidity. Paper trading is fine if you understand your trading exposure, not metal. I'm saying physical is a different animal. Physical behaves differently. Physical has different purposes. In a tight market, in a market showing stress signals, in a market where availability questions emerge, physical behaves like insurance, like protection, like a strategic position, not a tactical trade. You don't flip insurance for pennies. You don't sell insurance right before you might need it. You don't trade insurance based on daily price fluctuations. You hold insurance because the alternative, being exposed when crisis hits, is catastrophic. Another reality I want you to respect and prepare for because it's already appearing in markets. When markets get tight, when supply strains, when delivery capacity gets consumed, you start seeing more situations where dealers or sellers say, "We'll take your money now, deliver later," where payment happens immediately but metal arrives weeks or months later. Sometimes that's legitimate backlog. Sometimes it's genuine supply chain delay where the seller intends to fulfill but cannot immediately. Sometimes it's a fulfillment risk. Sometimes it's a red flag that the seller doesn't have metal and is hoping to source it before delivery date. The risk in tight markets isn't just price moves against you. That's normal market risk that always exists. The risk is, can the supply chain actually perform at the promised terms? Can the counterparty actually deliver? Can the metal actually be sourced? Will what you paid for actually arrive? That's counterparty risk. That's performance risk. That's why I keep emphasizing allocated verifiable custody and proof of backing over vague promises. Allocated means specific identified metal with your name on specific bars. Verifiable means you can audit, can confirm, can independently verify metal exists. Custody means proper storage with reputable vault operators. Proof means documentation, serial numbers, audit rights. These things matter enormously when markets tighten. So here's the conclusion. The comprehensive framework for understanding why delivery windows matter and why March specifically represents a potential inflection point. Physical delivery timelines are worsening measurably. What used to take days takes weeks. What used to take weeks takes months. Lead times extending continuously. Premiums are rising structurally, not temporary spikes that reverse. Sustained elevation in the spread between paper prices and physical acquisition costs. Quiet months are acting like delivery months. January showing urgency that normally appears in March. Forward months showing stress that suggests reduced buffer. And March is where the system gets tested. March is the active delivery month when stress concentrates. When delivery appetite normally peaks. When the system faces its hardest test. If delivery appetite continues rising into March, if January stress continues through February, if March shows delivery demand exceeding recent norms, we're not just watching a bull market. We're not just seeing price appreciation. We're not just observing commodity speculation. We're watching a credibility moment for the silver market structure, a test of whether the system works as designed. Either the system delivers metal against contracts that demand settlement and inventories drain, and we see how much backing actually exists. Or the system protects itself through rule changes or cash settlements or force majeure or delivery restrictions, and the market learns what paper is worth when physical is scarce, and trust breaks, and two-price behavior becomes permanent. That's why I'm watching this like a hawk. Why every delivery notice matters. Why daily inventory reports matter. Why premiums and Shanghai spreads and dealer availability all signal underlying stress. We don't guess about what happens next. We don't predict March outcomes with certainty. We monitor, we observe, we track structure signals, we watch whether conditions tighten further or stabilize. We sound the alarm when stress indicators flash red. Let me expand on why the countdown metaphor is appropriate, why March isn't just another month but a deadline, a moment where accumulated stress either releases or forces system adaptation. Think about how pressure builds in physical commodity markets. It's not linear, it's not smooth. It's not predictable day to day. Pressure accumulates gradually. Delivery timelines extend a few days. Premiums tick up slightly. Inventory drawdowns happen weekly. Small signals, subtle changes, easy to ignore individually. Then suddenly, often around delivery windows, accumulated pressure manifests. What was gradual becomes sudden. What was subtle becomes obvious. What was ignorable becomes undeniable. March represents that potential release point. That moment when all the accumulated tightness, all the extended delivery times, all the rising premiums, all the industrial demand, all the January stress, all converts into delivery demands against the exchange, into tests of whether backing exists, into forced choices between delivering metal or protecting the system. The countdown isn't to March arbitrarily. The countdown is to the moment when paper promises face physical reality, when claims test backing, when the market discovers whether the structure holds or breaks. Another dimension worth understanding about why delivery mechanics matter more than price charts. Markets can stay technically overbought for extended periods. RSI can flash high readings for weeks. Momentum can persist far beyond where technical analysis says it should reverse. But markets cannot deliver metal that doesn't exist, cannot satisfy physical demand from empty vaults, cannot convert paper to physical without actual metal. Technical indicators are opinions. Sentiment measures are psychology. Chart patterns are behavior. Physical inventory is reality. Physical delivery is truth. Physical backing either exists or doesn't. That's why watching delivery activity, monitoring who stands for metal, tracking whether contracts convert to physical, observing whether the system delivers or protects itself, matters infinitely more than watching where price closed today. Price tells you what speculators think. Delivery tells you what the market actually has. Now let's discuss what monitoring actually means practically. What specific observations tell you whether March will be the stress test that forces systemic change or just another active delivery month that the system absorbs normally? First, watch cumulative delivery notices as February progresses into March. How many contracts are standing for delivery? Is it normal for an active month or elevated? If March delivery notices exceed recent March patterns, if more participants demand metal, that's stress signal. Second, monitor COMEX registered inventory behavior. Registered is the category available for delivery against futures. If registered declines as delivery demands rise, if the backing shrinks while claims stand for settlement, that's the gap widening. That's stress building. Third, track physical premiums globally. Do Shanghai premiums over COMEX persist? Do dealer premiums stay elevated? Do acquisition costs remain high even if paper prices consolidate? Sustained premium elevation signals physical tightness that paper prices aren't capturing. Fourth, observe lease rates if you track them professionally. Lease rates measure the cost of borrowing metal. Rising lease rates signal metal is harder to borrow, harder to source for shorts, tighter physically. Fifth, watch delivery timeline reports from dealers. Are lead times extending further? Are out-of-stock notices increasing? Is availability declining? Worsening delivery timelines signal supply chain stress regardless of what price does. Sixth, monitor any rule changes or exchange announcements. If COMEX alters delivery procedures, if margin requirements change, if new restrictions appear, those signal the exchange is managing stress, is concerned about delivery pressure, multiple signals appearing together, delivery notices elevated and registered declining and premiums firm, and timelines extending simultaneously. That's not noise, that's structure screaming. Sure. That's the market telling you March will test the system. One signal might be random, two might be coincidence. Five together is pattern, is truth, is the structure revealing underlying reality. The final framework I want to leave you with is about how to think about position management if you hold physical silver through this period, through the countdown, through whatever March brings. If you bought physical as insurance, as protection against currency debasement, as strategic position in a structurally tight commodity, March stress doesn't change that thesis, doesn't invalidate your reasons for holding, might validate them. If you bought physical as speculation, as a trade, as something to flip when price rises enough, March stress might create decision points, might force choices about whether to sell into strength or hold through potential volatility. But understand that in tight physical markets, selling quickly isn't always easy. Finding buyers at spot plus reasonable premium is simple when markets are liquid. But in stress, in delivery crunches, in moments when everyone wants metal, selling physical back into the market might face friction, might require discounting below what paper prices suggest, might take time. Physical is not paper. Paper has liquidity, has continuous markets, has instant execution. Physical has transaction costs, has sourcing requirements, has verification needs. That's why physical works better as strategic hold than tactical trade, better as insurance than speculation, better as position than flip. If you hold paper silver exposure, futures or ETFs or mining stocks or derivatives, March delivery stress creates different dynamics. Paper can benefit from physical stress without experiencing delivery friction, can participate in price moves without worrying about premiums or lead times or allocated versus unallocated. But paper also faces different risks. If physical stress breaks trust in paper conversion, if two-price markets persist, if Shanghai trades dramatically above COMEX, paper might underperform physical, might not capture full repricing, might lag while physical gaps. Understanding what you own, why you own it, what risks it faces, matters more in stress periods than calm periods. Matters more when delivery windows test the system than when markets trade smoothly. The comprehensive conclusion, the synthesis of everything we've examined about delivery mechanics and March significance and physical market structure, this is not just another active delivery month. This is not just seasonal pattern where March shows elevated activity like it always does. This is potentially a defining moment for silver market structure, a test of whether decades of paper leverage can continue, a moment when physical reality either forces paper adjustment or paper successfully delays reality again. The signal suggests stress is building. January acting like March. Delivery timelines extending, premiums sustained, industrial buyers showing urgency, China restricting flows, inventories declining, multiple indicators flashing tension. March is the countdown destination, the window where accumulated stress concentrates, where delivery demands peak, where the system faces maximum test. Either backing exists, and metal delivers, and inventories drain, and we see physical reality, or backing is insufficient, and rules change and cash settlement happens and trust breaks. Both outcomes are significant. Both reshape markets. Both create opportunities and risks. If metal delivers, if March handles stress successfully, if the system proves it works, that's bullish for confidence but bearish for inventories. That drains backing. That proves demand is real. That validates tightness. If the system protects itself, if delivery gets restricted, if force majeure appears, if cash settlement happens, that's bearish for paper trust but explosively bullish for physical premium. That breaks confidence in conversion. That creates permanent two-price markets. That forces capital to physical. Either way, March matters. Either way, the delivery window changes everything. Either way, watching what happens is more important than predicting what happens. So the framework going forward is simple. Monitor daily, track delivery notices, watch registered inventory, observe premiums, note timeline changes, follow Shanghai spreads, read exchange announcements, let the structure tell you the story, let physical reality reveal itself, let delivery mechanics show whether stress is building or releasing. Don't guess, don't predict, don't assume you know how March resolves. Watch, observe, monitor, sound the alarm when signals flash red, stay informed when structure shifts. If this analysis helped you understand why delivery windows matter more than chart patterns, why March represents a potential inflection point, why physical mechanics reveal more than price action, subscribe to this channel. Turn on notifications, because we'll continue tracking these structure signals daily. We'll monitor whether delivery stress builds into March or releases early. We'll watch whether the system delivers or protects itself. We'll observe whether physical forces paper adjustment or paper delays reality again. The countdown is active. The window is approaching. The test is coming. See you in the next analysis where we'll review what the structure is telling us in real time.